We all know this disclaimer, right? The disclaimer that past performance is no indication for future performance. As in, just because Bitcoin went up in the last 5 years doesn't necessarily mean that it has to continue to go up in the next 5 years. So that's a disclaimer a lot of people do, especially in the investing world, right? Just because a fund went up recently doesn't mean it has to continue to go up. A lot of people still take this as a proxy, right? If something did well, probably there's some kind of correlation to future performance. I actually ran the numbers. Both on the stock market, but also on Bitcoin. Is there actually some kind of correlation between past performance and future performance? And if there is there maybe a difference between the different time horizons? So as in, when we look at yesterday's performance, is there a correlation to tomorrow's performance, or last week's performance to next week's performance, last month to next month, last year to next year, etc. When we run those numbers, right, and when we simply just go with the disclaimer, we should see zero correlation, right? There's no correlation whatsoever. If something went down in the past, it might go down or up, vice versa, right? If it went down, it might also go into any kind of direction. So that's what we would anticipate just based on this disclaimer. But that's why we do the math. We want to find out what's actually going on. Now let's start off with the stock market. There is indeed very little correlation in the small time horizons, as in yesterday's performance to tomorrow's performance, or last month's performance to next month's performance. There is quite a lot of correlation though for the last 2 years to the next 2 years. Especially once we split it up into 2 cases. So you could subsample the data, right? You could take the data sample where the last 2 years had negative return and where the last 2 years had positive return. You could split the data set up into those 2 brackets. And then you can look at the next 2 years. What was the performance? If the last 2 years were positive, there was actually still not too much correlation with the next 2 years. But there is a lot of correlation, negative correlation, when the last 2 years were bearish. When we had negative performance in the last 2 years in the stock market, we tend to have massively outsized performance in the next 2 years. In other words, it does make sense to buy the dip in stocks. There is not a lot of correlation with positive performance to next positive performance in stocks, but when the stock market crashed in the last 2 years, this is in general a very good buying opportunity. So it does make sense to get into stocks more at that point in time. Maybe to buy stocks with other investments that you have, sell those other investments, buy stocks for this. Maybe if you've got cash laying around, buy then the bottom. Maybe if you're a bit more risk-taking and you can surf a loan, you've got very stable income, maybe even take out a loan, buy stocks at that time. The expected returns are roughly double when you buy a dip when the last 2 years were negative. So that's a good thing to know, right? It's good to know that past performance does indicate future performance if the past performance was negative, and it was negative for the last 2 years. So that's good to know. In general, right, just if you think about reshifting your allocations, you probably, or at least you should have, your money in different asset classes. And if you've got, say, some gold laying around and the stock market crashed in the last 2 years, you should be contrarian, at least statistically speaking, and buy the dip.
This needs to go to 1 million, or March buyers now will make millions. This is how you get the clicks on YouTube, but this is not how you beat the market. To beat the market in crypto, you need to be better informed than the rest. You need to be better skilled than the rest. You need to do better blockchain analytics. You need to track other people's wallets and know what is the smart money doing. It's the boring educational content that forms skill that doesn't perform so well on YouTube though. That's why I created the premium membership. Feel free to check it out. We are tracking influencer wallets to find out what they are buying before promoting this on YouTube. We've got a lot of tutorials to help with on-chain analytics, to help with wallet discovery. And of course, there are also plenty of chats where we help each other, and also one-on-one conversations with me. So I'm messaging every premium member one-on-one directly. Once you're joining, you will get a message from me and you have the opportunity to directly pick my brain. Feel free to check it out. thebitcointrader.com, link is down below.
Now, in Bitcoin, we also have correlations. Obviously, I ran those correlation numbers, but they are very different The strongest correlation we see in Bitcoin is a positive correlation, not a negative correlation. So when the past was positive, the future tends to be positive as well. What's the highest correlation when we look at the different time frames? It's 4 months. So when the last 4 months were bullish in Bitcoin, we made profit in Bitcoin in the last 4 months, we've got a very high likelihood that the next 4 months will be positive as well. So past performance, to a degree, does indicate future performance. And this also ties into our moving average backtests. So I ran a backtest for moving averages, right? You can calculate these smoothed out lines on charts. And there's different durations for those moving averages, right? You could take the 100-day moving average, the 200-day moving average. And you can find out when you buy, whenever the price is above the moving average, so you ride the positive wave, right? That's when you are in the market. And you could do the opposite. Whenever the price is below the moving average, that's when you sell, or when you even bet on falling prices. You can run the simulations for different moving average durations. And the best moving average duration, by the way, is the 120-day simple moving average. So I've got the high correlation, 4 months in the past to next 4 months in the past. We also have the moving average, the best moving average being the 120-day. Thus, there is a real trend effect in crypto, not necessarily in stocks, but in crypto. If we are in a bull market, and that's indicated by the last 4 months performance, then it does make sense to ride the wave. And if we did not make any money in the last 4 months, it might make sense to be more cautious. So it's a very different psychology in those two markets, right? The crypto market is way more momentum driven. It's way more herd mentality. The stock market seems to be a bit more efficient, right? The stock market seems to be a bit closer to when prices are really low, when the return on investment is really high, when dividend yields are high, when the last 2 years performance was bad. It might make sense to pick up the pieces. In crypto, it can go down for quite a long time, right? It can go down by 70, 80% in the bear market. For the stock market, that's very, very hard to happen nowadays, right? The stock market will get supported at some point, be it simply just with money printing, be it simply just by inflating away the fiat value. So this video is simply just for the people that want to get the TLDR. Feel free to also run those numbers yourself, right? Feel free to open up an Excel sheet. Feel free to download the historical returns of the S&P 500 and of the Bitcoin price. Feel free to run those numbers yourself by checking what was the correlation, what was the performance in the last X years or weeks or days, and compare this to whatever comes in that Excel sheet in the next days, years, weeks, right? Run these correlation numbers, find out what kind of time window is the best. Do this with other assets, maybe do this with gold as well. I've never done this for gold, I've never done this for bonds. Maybe it makes sense to do something like this as well. Simply to get a feeling, a statistically significant feeling of how things can develop. Because that's probably better, right? Once you've got something that is backed by data, it's better than gut feel, right? If you've got a feeling based on data, it's better than just gut feel. Just because your friend said this is a good investment and then you start buying, it's probably not as solid of a ground compared to when you actually run back-tested simulations, when you actually run real correlation analyses. It's not necessarily a guarantee that you will time the market perfectly, but I think it's a potentially better approach. I think it puts the odds more into our favor. And so yeah, feel free to do this yourself. If you need some support with this, there's also the premium membership. So feel free to check this down below. It's thebitcoinstrader.com. There's all kinds of Excel sheets where I run backtests on various different analyses. You can also ping me directly over there, so you can send me direct messages via Telegram and ask me questions. I try to support. We have a community of developers, of backtesters. So if this is your topic, feel free to check it out. It's thebitcoinstrader.com. Again, it's thebitcoinstrader.com. Looking forward to seeing you there. There's also a free Telegram. The link is down below as well. Looking forward to seeing you in the free Telegram as well. See you over there. Cheers.